of it's certainly been a unusual and volatile start to this year, and we certainly don't expect to see that volatility die down anytime soon. As I said, my name's Stephen Dooley. I'm the currency strategist here at Convera. Looking forward to presenting our monthly global FX Outlook webinar for July 2023. I'm joined today with two of our strategists and analysts from around the world, Boris from Central Europe and Joe from North America. They'll both look at their key regions, and again, really does show the global research that we have here at Convera from all four corners of the globe. Well, I should say 3 corners of the globe. We need to get someone down at the Antarctic base, but for now, I think the 3 of us should be able to do. Let's have a look at what we're covering today, and maybe I'll get everyone to turn on their videos as we start off. We might just have a little trouble with the video at the moment, but maybe we'll get that up and running in a moment. But looking at what we're covering today, first of all, Boris will look at the global economic outlook, and really, as we mentioned, the main topic which we focused on in the webinar invitations and recently in our commentary on our reports and on our website is really the impact of inflation, which has remained much more persistent than markets had expected. It's caused central banks to raise interest rates for a longer time than many forecasters had expected. But we'll now look at how that's likely to play out in the second half of this year. Interestingly, while inflation has been high, core inflation has been high, it can turn somewhat quickly. Unfortunately, the medicine required can often be unpleasant. So that's part of what Boris will look at. Then I'll look at what's happening in the APAC region in terms of currencies. And it's been a very significant period, particularly with interest rate cuts in China, forcing the Chinese yuan sharply lower, and of course, volatility around the Australian dollar. Joe will look at the North American currency outlook, really important as we go into this month's Federal Reserve decision, and then we'll look at some of the questions that you've already posed for us, and some questions hopefully you'll ask us by using the Q&A tab on your Zoom controller. Before we go on, though, I'd like to ask the attendees here a question. We've got a number of businesses on the call today with leaders across sectors such as manufacturing, business services, and financial services. And we wanted to be better understand what macroeconomic or broader business issues are concerning our customers the most. And today we're looking to gather this information via a live audience poll to help guide today's presentation, but also give you the opportunity to hear directly from your peers and compare your views. So we will launch this poll now, and as the poll comes up, you should be able to see that we want you to think about the next 6 months and what issue or issues concern you the most today. Now, please select all that apply. You can select as many of these as you want, but you can see there, we'll keep this open for about 60 seconds. But the conditions that we want to know about what issues concern you today are cash flow, credit conditions, high interest rates or inflation, geopolitical trade risks, banking or financial market risks, supply chain diversification or transformation, digital transformation or automation, or other. So we've given it about 30 seconds so far. We'll give it another 30 seconds. And I'm really looking forward to finding out what the responses are today. A lot of what we get in these live polls really help us better understand what's important to our client base and the broader business community, and to help us really think about what material, research, or focus we should direct our attention in. So with 10 more seconds to go, and we'll close the poll. Okay, let's close the poll. I look forward to seeing what the responses are. Well, I'm glad that we've managed to identify the topic today, because it's high interest rates and inflation, which by far 89% of you said that that's a concern to you, and then closely followed by cash flow and credit conditions and geopolitical risks tied for second. But look, a number of other concerns out there, and that's no surprise: banking and financial market risk, supply chain diversification, and digital transformation. It just goes to show that there is a lot of concerns currently facing business today. Hopefully today's presentation goes some way to ensuring currency risk is one factor that does not materially disrupt your plans over the coming months. In regard to other issues such as geopolitical risks and trade risks or digital transformation, we actually recently published a research report that speaks to these issues, and it's available to download via the resources tab on your Zoom controller. So we'll upload that link now. You can download this. This is the trade and B2B report out with our forecasts out to 2028. Our leadership team recently published this and presented this at the Money 2020 conference in Amsterdam in early June. It was very well received. So as I say, go to the resources tab there on your Zoom controller, and you can download the B2B payments report. Okay, thank you very much for contributing to that. That's really great and really helps us understand what's important and what we should be looking at today. Now let's move on to the body of the presentation. And really, as we mentioned at the start, despite the sharpest sequence of policy tightening that we've seen in living memory, inflation, particularly core inflation, around the world remains too high. Now, global growth is clearly starting to slow, particularly, as Boris will point out, if we look at the manufacturing sector. That's really important for China and really important for Australia. But as this growth slows but inflation remains persistent, central banks face an almost impossible choice. Will they continue to raise rates and make a recession more likely? Or can they pause rate hikes at the risk of causing inflation to become more entrenched? The uncertainty around these policy choices will drive foreign exchange over the back half of 2023. And that's really what we want to look at today. Now, if we look at how FX markets traded in June, you can see that this tension between inflation and worries about growth have been the big driver in markets so far in 2023. So the US dollar was actually lower for most of June, and that's because the Federal Reserve had started to signal that it was near the end of its rate hiking cycle after a sequence of rate hikes at every meeting since March last year. They paused, they skipped for the first time in June, but they really stress that they expect to see more rate hikes, probably in July, and then probably in September. The reason they said this is because even though headline inflation started to fall, it's fallen from close to 9% a year ago to 4% now. Core inflation has remained sticky at 5.3%. So with inflation still sticky, this is why the Federal Reserve continues to raise rates, even at this late stage of the cycle. And that's why the US dollar has actually rallied in the back half of June, and certainly over the last couple of days of this week. Overnight, the Federal Reserve minutes again suggested the Fed is looking to raise rates again in July and September, and that's what's caused the US dollar to strengthen over the last 24 hours. The British pound in June remains strong and remains one of the strongest, well, the strongest currency in the G20. The Bank of England surprised markets with a 50 basis point hike in June, raised rates to 5%. But that's no surprise. Headline inflation in the UK at 8.7%, the highest in the developed world. So that's what's been driving this pound strength over the first half of 2023. And that's why markets believe the Bank of England will need to continue to raise rates. It's what's providing such support for the British pound. And if you look at the pound versus a whole range of currencies, particularly throughout Asia, it's been outstandingly strong because of those expectations of rate hikes. It's a little bit different in the euro. While it has been strong and while markets do believe they will see further rate hikes from the European Central Bank, this is where that tension between worries about inflation and worries about growth are really starting to intersect in the EU. We found out over the last few weeks that Germany officially in a recession, and that's why markets, while they can clearly see the concern about inflation in the Eurozone, they're also more concerned about growth. So the euro has been strong, but the euro-US dollar, like Joe will discuss in a moment, is having real trouble pushing significantly above 110 in the euro-US dollar. And for now, that's capping some of the euro's gains. That said, again, throughout Asia, the euro very strong. And then finally, the Australian dollar. Again, what drove the Australian dollar to be stronger in June was an unexpected rate hike from the RBA. And the RBA had earlier indicated, earlier in the year, that it was nearing an end to a rate hiking cycle, but persistent inflation, again, even though we saw last month a big drop in headline inflation from 6.8 to 5.6, core inflation remains stuck around 6.5%. Another reason why, even though markets thought rate hikes were done, they've come back. And again, it's because even though headline inflation is falling, core inflation, what central banks tend to look at the most closely, remains persistent. As I said, it doesn't mean it will remain persistent into the back half of this year. And that's, again, what Boris will talk about. Before we pass on to Boris, I want to look at the key market events to watch for the month ahead. And of course, it's no surprise, as it very often is, the Federal Reserve decision on the 26th of July. Of course, that's the morning of 27th July, our time, throughout Asia. But as we heard from the Federal Reserve minutes last night, the Fed does believe it is more likely to hike rates. And as we can see from the market pricing, 87% chance of a 25 basis point hike, according to the Refinitiv market platform. So markets believe the Fed will need to raise rates further from their current range of 5% to 5.25 to a new range of 5.25 to 5.5. Before that, of course, we get the US jobs number on the 7th of July and the US CPI number on the 12th of July. So they're the two big US events that will drive market volatility over the course of this month. Away from the US dollar, the other two big central banks, the ECB meets on the 27th and the Bank of Japan, highly unlikely to make any change, meets on the 31st of July. And of course, the Bank of Japan on hold and not hiking rates, the People's Bank of China cutting rates, are really driving some of the major divergence in currency markets. There's a reason why the Chinese yuan and the Japanese yen have been so weak. Apart from that, the other big central bank decision is the Reserve Bank of New Zealand on the 12th. The Bank of England, of course, having a holiday this month. They're back in early August. All right, that's enough from me. I'm going to pass on now to Boris. He's going to look, as I mentioned, about this tension between inflation and growth and what it means as we look into FX markets for the second half of this year. Boris.
Well, thank you, Stephen, for the brilliant introduction and then the good segue to this part of the presentation. Of course, a warm welcome to everyone listening to this webinar as well from my side out of Europe. I'm very happy to join our FX team today and to just try to explain some of the macroeconomic developments that have been shaping financial markets for a couple of months now, and to also try to give a bit of a forward guidance going into the month of July in terms of what we are looking at. Stephen already laid out the key events that investors will focus on in July. So my part is centered more around bringing these individual data points together, not only into broader themes, but also certain narratives to just better understand market behavior. So we'll be looking at three specific themes: inflation, monetary policy, and the macro side of things. And then before we dive into our focus theme and focus event for this month. So going to the first page, I would like to talk about inflation first and foremost. For some of you who have already joined our previous couple of webinars, you would know that this topic has pretty much been a constant theme throughout the series, given the weight it has been holding for not only central banks, but also households, companies, and financial markets. It is still the case that inflation in general and these individual inflation data points, as Stephen mentioned, remain relevant for us today. However, it is important to recognize and to know that the inflation dynamic have started to change, and that the debate surrounding these price developments is more than just a binary question of, is inflation going down or is it going up in a particular country? We know that inflation in most part of the developed world has already peaked sometimes between Q3 last year and Q1 this year. And given our leading indicators, we do expect consumer prices and producer prices to continue falling, even more so than the broader consensus expected. However, again, the debate has shifted from not only gauging where inflation will peak to the question of how fast will inflation go to the 2% target again. And in this chart, I think we can clearly see that these 2 points have to be treated differently. Because while the blue line in this chart, which displays the share of countries with extremely high inflation, meaning inflation above 8%, has clearly fallen in recent months, the green line showing the countries with inflation above 4% has experienced a much lesser fall. And the share of countries with inflation of around 2%, meaning the share of central banks hitting their inflation target, has not really moved that much in the last couple of months, shown in gray at the bottom. And this, I think, for us is crucial, because it is true that headline and goods inflation are falling, as Stephen already mentioned, just based on base effects and the normalization of supply chain factors. But the demand-driven stickiness of services and also the core inflation have made it difficult for central banks to proclaim victory over the fight against inflation. And that is why policymakers have been quite vocal about their commitments to, again, bring inflation back to target in recent weeks and recent months, pushing back pretty much against any suggestion about premature easing of policy. It is also important to note at this stage that, again, we do think that inflation in the US, in Europe, and also in Australia will fall more sharply in the medium term that is currently priced in. And this is a thesis, again, we lay out in our daily market updates and other publications. But because of the extreme data dependence of central banks and the importance of just this next single inflation print or the next single jobs report, it could be, well, the case that an upside surprise in this individual data point leads central banks to hike more than we currently expect, which in turn, again, would increase the likelihood of a recession in the major economies. And I think markets tend to agree with this view, as we can see on the next slide. Because the last couple of months, I would say, we have clearly been shaped by inflation in general coming down a bit, while policymakers continuing to shift the focus and their attention from headline, which in normal cases is the target the central banks try to hit, to core inflation. And this shift from headline to core has pretty much given policymakers the ability to remain hawkish and to prop up the front end of the yield curve, even though the global economic momentum and global economic activity has started to weaken. And this is what we can see in this chart here, which in basic terms just shows us the average aggregate yield curve for the Eurozone, the US, and the UK. And the repricing of these rates at the short end of the curve, meaning the yield or the interest rate on the 1, 2, or even 3-year government bond has been quite impressive. If we just look at the 1-year yield in particular, it has risen from around 4.1% in aggregate to around 4.7% in a time span of just the last 4 months. However, again, the same thing cannot really be said about the long end of the yield curve, which, as we can see in this chart, remained absolutely stagnant, not only throughout the second quarter of this year, but for most of the last 7 to 8 months. So markets are clearly indicating to us that, yes, central banks are being hawkish, and these hawkish policymaker speeches and sticky core inflation are enough to prop up the front end of the yield curve. But longer term investors already see and position themselves for the disinflationary process, which has already started, and the higher probability of a recession occurring, which means that it pushes up the demand for these longer dated safe havens and in turn pushes down the yield curves, or at least the yields on the longer end down. And this is precisely why in this segment, we basically ask the question, what does higher for longer mean for markets? Because we know that markets interpret it as not expecting any rate cuts in the year 2023, let's say for the major G10 central banks. And this is why they have pushed out rate cutting expectations well into 2024. And because of the divergence between the yields on the short end, which have risen, and the long end, which has pretty much remained constant, the 2-stance yield curve, which displays for us the difference between how much investors get paid to hold short-dated bonds versus long-dated bonds, fell to the most negative since the 1980s in the US and Germany. So the yield curves, or the percentage of yield curves that are currently inverted in Canada, for example, is 100%. In Australia, it's 85%. In Germany, it's, I think, 75%. So all these are inverted. And this inversion of the yield curve has historically been one of the best indicators for an upcoming recession. And this already brings me to my third global market theme on the next slide, namely the impact of monetary policy on the real economy. And as with the inflation side that I presented in the beginning, the importance here really lies on understanding the complexity of the topic and not really asking these binary questions of, is country XYZ in a recession? It is a fact that some economies have, in particular here in the US, have held up much better than economists have feared in the beginning. Hard data points like industrial production, retail sales, consumer spending, and also the latest 2 jobs report numbers have all continued to outperform expectations. But other parts of the economy, like the property market and the manufacturing sector, have been in a recession for multiple months now. And this is why sometimes it is important to look at individual sectors instead of the economy in general. Companies, for example, in the manufacturing sector are more interested in their particular field and how producer and factory prices develop instead of just focusing on core inflation like central banks do. And because sectors have different sensitivity to the global business cycle and also are impacted just differently by monetary policy, we get this divergence of the weak industrial sector versus the still strong services sector. And in the end, our opinion is that these will just have to converge at one point or the other in the current business cycle. And there are valid points and arguments for both the services sector to pick up, for the services sector to fall to the levels of manufacturing, meaning going to recession, or for manufacturing to be pushed up again by the resilience of the services sector. But with most of the shock of tighter monetary policy estimated to start impacting the real economy in the second half of this year and then in the beginning of next year, it is really difficult for us to imagine the manufacturing recession not spreading to the wider economic activity right now. And so the recession debate, in my opinion, and this is something we can explore in the next slide, is really the key to the inflation and the monetary policy questions that we laid out in the beginning. Just as a reminder of these two questions, we asked, where will inflation settle at the end? And what does higher for longer mean for markets? And again, both are tied to the overall health of the economy, because the repricing of the rates in the short end that we showed in the second slide is a consequence, a direct consequence of markets pricing out these rate cuts from the Fed, because economic data has been better than expected and core inflation has been higher than expected. In Europe, granted, it is a bit different because economic activity has faltered and is starting to weaken, but these high core inflation rates have still been able to justify higher yields for investors. In our opinion, again, core inflation can only be elevated for so long with an economy going into recession. We know from historic perspectives that recessions and high policy rates in combination tend to bring down inflation. And with policy rates this elevated in pretty much most of the developed world, and what we can see here, the New York Fed recession probability being elevated at around 70%, which is the highest level it has been since the 1980s, the pressure on central banks to turn less hawkish will start to be visible at some point during this year. Again, probably, as Stephen mentioned, not at the upcoming July meetings, but in our opinion, the next rate decisions in September and then even in November will be more open with the bias shifting to pausing instead of hiking rates. And while it would be the first time for the US not to fall into a recession while the yield curve is disinverted as it is right now, it has to be said that it is still possible. It is important to know that nothing is set in stone, especially with today's macro and market volatility. And one reason for it would be that we laid out in our daily market updates is because of these pandemic-related effects and the huge stimulus we got during the pandemic, consumers have just been able to weather the inflationary storm much better than anyone would have expected. And if we really get a cyclical uptick of the manufacturing sector, which is currently again in recession, before the services sector turns negative, we could in fact get a soft landing in no recession scenario. But this would mean, again, in the medium term, that central banks would have to keep hiking rates because of sticky inflation, which would once again increase the recession risk down the road. The final topic I would like to address in my final slide is, again, the divergence between the asset classes in recent months, which will be, I would say, a good segue into our FX discussions. So in this chart, we can see a proxy indicator for the US financial market. We can see the proxy indicator for US stocks in green, we can see the US bond market, and we can see the US dollar in reverse. And the things I'm about to say should hold true for most of the developed world. So starting in 2022, cross-asset development since the beginning of last year can really be split up into these two distinctive phases that we can see right now. The first one is the double sell-off of risk assets like stocks and inflation-sensitive assets like bonds from January to October of last year, from which, of course, the US dollar has greatly benefited. And then the second consequent rebound of equities and high beta currencies like the euro, the pound, and the Australian dollar starting from October. But still, what we can see here, if we focus our attention on the last couple of months, is that there has been quite a strong divergence between what those three asset classes are pricing in right now. Why, for example, did the US dollar continue to sell off while bonds remained pretty much stagnant? And what has been driving the recent stock rally, if not the expectation of Fed rate cuts, which again, as I explained, have pretty much all vanished for the year 2023. And there is a clear disconnect between, again, what equities are pricing right now and what fixed income is pricing in. And FX, if we look at the dollar, has so far followed risk assets like stocks and the global sentiment more so than interest rates, which can partially explain why the euro has been a bit more resilient against the greenback, even though we had a recession confirmed in Germany. So again, just to summarize my key points here before handing over to my colleagues, market participants have shifted their focus from headline to core inflation in recent months. And this has allowed policymakers to continue hiking while ignoring the weakness of these pro-cyclical sectors of the economy, like the manufacturing sector. And this has once again led to yields rising at the front end, leading to the yield curve being as inverted as it is right now. However, as we explained in this slide here in the chart, stocks and risk-sensitive currencies have remained quite resilient to the higher for longer narrative, primarily, in our opinion, because of the tech and AI-driven boom that has been propping up the global sentiment. And because rate cuts have indeed been postponed, but not really completely canceled, because markets still expect most of central banks to cut interest rates at the end of next year. And in our opinion, like the divergence between the manufacturing and the services sector and the question of which will catch up to which sector, so too, in our opinion, must the split between these equities and the bonds converge at some point or another. And I think these two convergences will make July quite an interesting month for us, especially against the backdrop of all these central bank decisions that Stephen has been talking about. So I think with this in mind, I can hand over to Stephen, who will dedicate some time to explain what has been driving FX markets.
Fantastic. That was great, Boris. Thank you very much. Really fascinating stuff. And like you say, there is that real tension out there in markets between central banks and those decisions they need to make when inflation is still high. But like you showed, that manufacturing space in particular, deeply in recession. It means that there certainly creates the potential for a very quick turn in narrative as we enter that second half of this year. And that kind of turn in narrative is what can drive, extreme movements and volatility in FX markets. So let's have a look specifically at some of the FX markets around the region and what their current position is and how this kind of volatility might affect them. Now, looking at where we've seen the most volatility over recent days, it's pretty clear across the region, across APAC, that what's driving this volatility is that divergence or the difference between policies between central banks. Where we've seen the most volatility is in the Australian dollar, which has seen interest rates increased in June, certainly with that surprise rate hike. The RBA went on hold in July, but that surprise rate hike in June contrasted with out of Japan and out of China, rates on hold in Japan and rates being cut in China. So very big moves over June in both of those currencies. Now, of course, volatility creates risk for businesses because a sudden 8% move in the Aussie yen over a month can have an impact on business payable and receivable. Similarly, in the Aussie CNY, which had that 7.3% rally in June. Compare that to the year to date, which is only 8.5. So the Aussie versus CNY moved almost as much in June as it's moved for the rest of the year so far. So quite an incredible amount of volatility, and again, created by these changes in central bank moves. As Boris said, we might see more of these unexpected moves as central banks try to adjust to those twin imperatives of inflation and growth. So again, it illustrates where the potential volatility might be seen over the back half of 2023. A couple of other markets to note is the Aussie US and the Kiwi US both continue to see high levels of volatility, particularly the Aussie US. And again, as we mentioned, that unexpected increase in rates at the start of June drove that. Where we're seeing less volatility is in the dollar Sing, really quiet period in that market, which has been stuck in a range for some time between that 132 and 136 level. Let's look at where, away from volatility, but where the value is, and it will probably come as no surprise, but again, the Australian dollar or the US dollar versus the Japanese yen or the Chinese yuan is where the value is really flashing at the moment, particularly the Aussie yen. In the case of yen buyers, we can see we've moved to quite an extreme range where we are almost at 7 or 8 year highs in the Aussie yen. And that's why you can see that green there at the top, 5% above its year to date average, 8% above its 2-year average, and 17% above its 5-year average. So the Bank of Japan on hold, the Reserve Bank of Australia raising rates, really causing quite an extreme dislocation in the Aussie yen. Similar with the US dollar, Chinese yuan, you can see a 4% move against its average on a year-to-date average, 6.6% on a 5-year average. Again, the dollar CNY up above 720. Historically, the dollar CNY has tended to turn between 720 and 730. So again, some really extreme moves in one direction in markets at a moment. Dollar CNY is another example. The Australian dollar versus the CNY has been caught up with that at 2-year highs, and again, a 3% premium to its year-to-date average, a 1.1% premium over the 5-year. On the other side, where are we seeing markets at deep discounts versus their ongoing averages? Well, the Aussie dollar under pressure again versus the US dollar, and this is really a growth story where the growth in the US continues to certainly relatively outperform what we're seeing in Europe and what we're seeing in Asia. That's causing the Aussie dollar to underperform. It's also causing the New Zealand dollar to underperform as well. And we mentioned earlier that the euro has been supported, not as much as the British pound, but it has been supported due to expectations of further rate hikes. Inflation very high, core inflation still at 6.8% in the Eurozone, and expectations of further rate hikes to come, causing the Aussie euro to be at a deep discount versus its long-term average, 2% versus year-to-date and 3% on its 5-year average. So that gives you an idea in terms of the markets, where we're seeing markets that are more stretched to the top side, Aussie yen, dollar CNY, more stretched to the downside, Kiwi US, Aussie euro at a discount to their premium, and those currencies that are trading broadly within their long-term moving averages, dollar Sing and the Aussie Kiwi. Okay, so next I want to look at some of the forecasts we have as we roll into the back half of 2023 and look further out into 2024. And you can see here the Aussie US has been downgraded over the last month. You can see the dotted line there is the June baseline forecast. The solid grey line is the July baseline forecast. And you can see that's been downgraded over the last month. And that's again been because of this slowdown in growth across Asia, most notably in China. The reason why we saw rate cuts from the People's Bank of China in June is because concerns about growth, and that's what's impacting on the Aussie dollar. Of course, if we see concerns about growth in China, and this is tied in very much to that manufacturing collapse in activity that Boris mentioned earlier, because as manufacturing slows, the two dominant global economies that are impacted the most are Germany. That's why Germany's in a recession, and China, and that's why China is underperforming. So that's why the Aussie dollar forecast has been downgraded over the last month or so. Is there potential for the Aussie to fall further? Yes, and that will come down to the Federal Reserve. If the Fed does end up raising rates further and the Reserve Bank of Australia is on hold, then that can pressure the Australian dollar versus the US dollar. Again, it comes to this tension between inflation and growth and the decisions that central banks will make. The Aussie US, of course, is one of the most volatile currency pairs in FX markets. On average, since it floated in 1983, it moves on average 19% per year. So looking at that grey section, which is our core central scenario over the balance of this year between 65 and 69, that understates the volatility that we could see. We can move down in that purple area, we can move up into that green area, and that would be a perfectly reasonable end to 2023 because the Australian dollar tends to be a very volatile pair. The Kiwi US forecast has remained broadly flat over the last month and into the future, low 60s. Again, global growth, particularly Chinese growth, impacts on commodity currencies like the Kiwi, and the Kiwi is also being pressured by the fact the Reserve Bank of New Zealand said at their last rate decision that they are looking to keep rates on hold. They said that their terminal rate, their expected rate is 5.5%, and that's where they most recently raised interest rates. Doesn't mean they can't change their mind, but that's caused the Kiwi to underperform. And again, our view is that this is likely to remain under pressure. Any move up towards 63 over the course of this year, we would see as an opportunity because our central scenario is between 59 and 63 for the balance of 2023. The dollar CNY, this has been where we've seen the biggest revision to our forecast over the last month. And of course, that has been because of two reasons. First of all, this slowdown in growth. We saw it yesterday with their services PMI falling sharply from close to 57 to 53, a big drop in activity. As we see Chinese growth slow, we're seeing more stimulus. We saw a sequence of rate cuts from the People's Bank of China in June, and that's what's caused the dollar CNY to push up to this 720, 730 level, historically near 15-year highs on the dollar CNY because of this Chinese yuan weakness. So those weaknesses caused those forecasts to be lifted, and again, for the balance of this year, looking for the dollar CNY to remain above 7, and again, that 720 to 730 level, historically a real line in the sand for the People's Bank of China, where they're looking to manage and keep the dollar CNY below that level. And finally, the dollar Sing, again, a market that, as we said, low volatility recently, very much trapped between a trading range between 132 and 136, and we expect that to remain broadly near that level. That said, it can drift that towards the lower end of this level as the US Federal Reserve nears the end of its rate hiking cycle. As Boris said, that's a core view that as the Fed gets closer and closer to the end of its rate hiking cycle, the US dollar can start to drift back lower, particularly versus the Singapore dollar, which has historically been quite strong. Well, certainly a lot going on globally and a lot going on across APAC. But of course, as we mentioned, a lot of what happens in July is going to be driven by the outlook from the Federal Reserve. So now I'd like to pass over to Joe, our North America analyst. And Joe, you'll be able to run us through what's happening in the US dollar and some of the key US dollar markets. Thank you, Joe.
Thank you, Stephen. Terrific insights and that update from the APAC region. Wow, I didn't realize it's been 40 years since the Aussie dollar was floated. So really good insights there. Yeah, so for central bank policy, that has been the main source, or really the driving source of FX volatility really around the world. And that has certainly been the situation here in North America. That is certainly the FX landscape here in this region. For the dollar index, though, when we got to the mid-year points, the dollar index was really little changed. Having said that, but still, we did see some notable volatility for the greenback. For instance, the dollar so far this year is trailing behind its rivals to the north and to the south. To the north, certainly the Canadian dollar has outperformed against the greenback, and the Mexican peso, among other currencies, they have dominated the greenback. USD MXN, as we can see here, as the chart shows, does rank towards the top of the volatility chart, especially on a year-to-date basis. Dollar Mexico has ranged this year between 19.5 to 17, and that represents a double-digit volatility of nearly 15%. And as the chart also shows, it shows that the pair, Dollar Mexico, is situated near the bottom of the range, whether you're measuring that over the last 30 days or since the beginning of the year. So again, monetary policy, that has been the driving source of the peso's outperformance, thanks to Mexico's record high interest rate. We're talking 11.25%. That is a level that's more than double America's comparable rate of just above 5%. Now, the situation is a similar one for dollar Canada, dollar CAD, which has spanned a range so far this year of 131 to 138. Canada was the first of the big central banks to pause rate hikes and move to the sidelines after raising them aggressively to try and get a handle on inflation. But Ottawa, they didn't remain there. They didn't stay in the sideline. They actually hiked rates again last month. They did so by a quarter point. They raised their key rate to 4.75%. That is the highest level in 22 years. And you get the sense that the Canadian dollar, or the loonie, as it's affectionately known, has also been supported by Canada's economy, whose resilience is really keeping the door open to another rate hike. We're going to hear from the Bank of Canada next week on the 12th of July, and it's considered a close call whether or not we'll get another rate hike from Ottawa. And this week's jobs report from Canada, we'll get that on Friday. That could be very important. Who knows, maybe even decisive for next week's meeting of the BOC. So we're going to closely watch that one. Now, on the next slide, in terms of the value indicator, certainly the value indicator helps to show how much bang one currency is getting for the buck, in this case, the US dollar. And I really want to highlight dollar yen, USD JPY, whose strength has been quite sharp. We continue to see significant strength for the dollar versus Japan. And again, the main factor has been a familiar one: monetary policy, or simply interest rates. While the Fed and other central banks have raised rates drastically, Japan has been more reticent about shifting away from these super low interest rates. It certainly took a long time for Japan to get a handle on deflation. And I think that's a big factor behind policymakers' hesitancy to move off these low interest rates. So if I could draw your attention here to the top line, you can see that yen weakness, that has been a popular theme, whether we're talking year to date, really since last year, or if you're going back a few years, 2 years and even 5 years, you can see really exceptional yen weakness. Nearly 13% has been the difference over a 2-year horizon, and over a 5-year horizon, it's been more than 20%. So that just goes to show how monetary policy is really weighing on the Japanese currency, because if you compare Japanese interest rates, they're just below zero at minus 0.1%. By contrast, the Fed has jacked up interest rates to just above 5%. And so those interest rate differentials, that has been the main thing that has really propelled the dollar higher. And as we have these ongoing expectations that maybe the Fed isn't done raising rates, well, that continues to put upward pressure on U.S. Bond markets. The yield on the benchmark 10-year yield continues to creep higher. And as it does, that tends to be really influential for some of these yield-sensitive currency pairs, and certainly dollar yen is one of the more yield-sensitive currency pairs out there. So one of the things we do want to mention is that as the yen continues to fall, and where we are now, the 144 to 145 range, this really harkens back to last fall. Last September, we saw the Bank of Japan, or we saw Japanese authorities rather, intervene for the first time in 24 years to try and put a floor under the Japanese yen. And here we are, the middle of 2023, and we're back near this 145 level. That is a potential line in the sand for how much Tokyo would tolerate a weak yen. So if we continue to see the yen drift lower, maybe it has to do more with the speed, or if officials consider yen weakness to be a bit excessive. But the thing that the market is looking out for is the potential for Japanese authorities to step back into the market and maybe sell the greenback and buy the yen to try and slow the yen's descent, or at least try and offer some stability over the short run. So that's going to be a key thing that we're going to be looking out for. As we move to the next slide here, I do want to talk about euro dollar in terms of what to expect going forward. We've seen the euro rise about 2% over the first half of the year. It's done that against its U.S. counterpart, and that's as the market is pricing more rate hikes to come from the ECB compared to what the market is thinking for the Fed. So we saw Euro USD kicked off the year at 107. We ended June at 109. So a little bit of upside for the single currency, and it's really been mitigated because we've seen a lot of economic weakness. We heard from Boris, we heard from Stephen, and we've got this recession going on in Germany. And so that has the market a bit concerned that maybe there's less scope for the ECB to raise interest rates if the largest economy over there in Europe is already experiencing at least a technical downturn. So that's one of the things we're going to have to be on the lookout for, whether or not we continue to see, it's going to matter really what overshadows the other. Ongoing rate hikes, does that offer yield support to the euro, or does that spell an even weaker economic outlook? So that's one of the things we're going to look out for. In terms of upside for the euro, perhaps if we could see a bit of a global recovery, if China's recovery starts to show signs of gaining traction, that would tend to be positive for the euro. Maybe we can see a move towards 110 or maybe even higher. Now, in terms of downside risk, certainly what could catalyze some weakness in the euro, maybe down to 105, would be if we were to see a deeper downturn for Germany, or if these rising interest rates by the ECB, if they were to pump the economic brakes a bit more harder, that could certainly be a key factor that could push euro dollar downwards. Now, I do want to jump to a few more slides here. We do have sterling. Sterling kicked off the year around 121. Sterling USD, that is, kicked off the year around 121. It climbed as high as 128.5 last month. That was a one-year peak, and sterling has really been outperforming. It's been up about 5% year to date, cable that is, and it ranks as one of the year's strongest major currencies. And a lot of that has to do with the outlook for the Bank of England. The Bank of England has also been aggressive in raising interest rates. The BOE last month, they raised rates up to 5%, the highest level in 15 years. And the thinking now is that if maybe 6% might be in play if inflation over there in the UK, which Steve mentioned is the highest among developed economies, if inflation only inches lower, maybe that could that could be the type of situation that offers further yield support to the pound. But then again, like I said, the other side of the coin of these rising interest rates is that it could come at the cost of weaker economic growth and maybe even a downturn. So that's one of the things that could keep the pound susceptible to the downside if we were to see a growing risk of recession over there in the UK. What if the UK economy fares better than expected? Well, maybe we could see the pound claw back some of its. Maybe the pound could actually add to its recent gains against the greenback, but we'll have to keep our eyes on how the economy tolerates the higher interest rates over there. And then lastly, for Canada, dollar Canada, that is, we've really seen this currency pair keep to a fairly even keel, and that has a lot to do with central bank policy in Canada as well as in Washington. It's on a similar path, and as a result, we've seen dollar Canada keep to a pretty even range there. Now, the greenback, it did recently fall to a 9-month low versus Canada. That was around 131. Perhaps we could see a move towards 130 over the course of the balance of the year. And that is if Canada's economy proves to be more resilient than expected, maybe that could lead Ottawa to raise rates further over the second half of this year. On the flip side, what could give dollar Canada a boost? Well, we'll have to keep our eyes on the Canadian economy in terms of how it's weathering the higher interest rate policy. Does it impact consumer and business spending? And we'll have to keep our eyes on the Fed. Is how much further will the Fed go in raising interest rates over the second half of this year? That's going to be a key consideration for dollar Canada going forward. So I know we're running low on time, so that brings us to the Q&A session.
Thank you very much, Joe. That was fantastic, and appreciate you getting through that within the time. You're right, we have got Q&A now, so we'll just hang around for 1 or 2 more minutes and answer the questions that we do have. In the meantime, I just wanted to remind everyone of the B2B trade report. That's available there in the resources section of your Zoom controller. Remember, that's the report we mentioned earlier that looks at major issues such as geopolitical, trade risks, and digital transformation. So please, if you are keen for more information in that space, download that link. That really is in line with what we do here at Convera, at International Strategy, where what we're trying to help global businesses is to understand the risk and to mitigate that risk in currency volatility, help manage the risk from geopolitics. You can drive sanctions and other risks such as climate change. But if you do have questions, please ask in the Q&A. We've got a couple here. First question, I mean, maybe I'll handle this to Boris as our macroeconomic analyst, but any indication on expected earnings of US companies in a year, whether it'll be contraction, flat, or expansion? Boris, do you have any update on US company earnings in the outlook in the near term?
Yeah, it is a good point, Stephen. Thanks for the question. So the outlook remains a bit more darkened looking at the second half of this year, especially because looking at the last data points that we have, which was Q4 last year and Q1 this year, US companies nearly or almost avoided a earnings recession because Q4 was negative on a year-on-year basis, and earnings in the first quarter of this year just barely scraped into positive territory with a year-on-year acceleration of 0.1%. And now the expectation or the consensus of markets is that earnings will fall by around 5 to 6% in the second quarter, which the earnings session should start at the middle of July. So this is again an open question, but given that most leading indicators for earnings, which are the US PMI numbers, which are deeply negative, and also inflation starting to fall, which puts downward pressure on the pricing abilities of US companies, both of them are indicating that it will be much harder for companies to again raise prices and kind of put these higher input costs to the consumer, which means that earnings should come down a bit in the next couple of months, which normally should be negative for stocks, but obviously we're not really seeing it because of the expansion of the tech industry and the AI boom that we have seen over the past couple of months.
Great, that's fantastic. Thank you, Boris. It is interesting that, as you say, earnings might have come off, but equity markets still rallying higher, particularly with that AI and tech space. I think the Nasdaq was up almost 40% in the first half of this year, and certainly not what market forecasters were expecting at the start of this year, when there was that concerns about how markets would handle interest rate hikes. We've got one more question, maybe time for one more question. And there's the outlook for, the question is, what is the outlook for the Aussie versus the Euro? Again, of course, like we've mentioned, that really comes down to the respective central bank policies of the two economies. And for now, the Euro has been stronger, with expectation that the Euro's got more work to do to try and contain inflation. The deposit rate in the Eurozone at 3.5%, the refinancing rate at 4%. That compares with the US at 5.25%, the UK at 5%. Australia at 4.1. There's a view that the Eurozone has more work to go and might need to lift rates further. So that's what's kept the Euro strong and kept the Aussie Euro lower, near that 60 level. That said, as Boris pointed out, the impact of slow growth, particularly in Germany, means that the European Central Bank might need to pause sooner rather than later. And if that's the case, the Aussie Euro can press higher. So our forecast for the Aussie Euro is a move back towards 62 over the balance of this year. And if you look technically, the Aussie Euro has been trading between 60 and 63 for most of this year. So for now, it seems like that range is most likely, with our view, a move up towards 62 at the end of this year. We might wrap it up for questions there. I'd like to thank Boris and Joe and everyone behind the scenes for helping. Thank you all for coming today. We really appreciate your coming to the webinar. Just to make note that in the resources tab of the Zoom controller, you can subscribe to our Currency Convo daily market report. You can click on the link there in the resources tab if you want more information. You'll receive a recording of this webinar within the next 24 hours. And of course, if you need anything at all, you can contact myself or any of the team here at the Convera Customer and Market Insights team. Again, I'd like to thank everyone, Boris and Joe in particular, for contributing today. I'd like to thank everyone for coming along and look forward to seeing you next month for our monthly Currency Convo webinar series. Thank you very much.